Good afternoon and welcome. Moss Adams is pleased to present today's webcast, How to Keep Form 990 Consistent with Your Financial Statements, to members of Southern California grantmakers, Northern California grantmakers, and San Diego grantmakers. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning. My name is Cameron Green. I'm the Director of Professional Learning and Communities at Southern California Grantmakers. It is a pleasure to partner with Moss Adams on this fantastic program. And on behalf of Philanthropy California, we hope to continue to bring you incredible programming to help you with your work. We hope that you'll continue to visit our program pages on our respective websites in the new year to introduce and to also inform you of upcoming programs with Moss Adams. Again, thank you again to Moss Adams for this partnership on behalf of Philanthropy California. Pam?
Thank you, Cameron. Now I'm pleased to introduce today's presenters from Moss Adams, Lauren Haverlock, Senior Manager, and Matt Parsons, Senior Manager. With that, I'll turn it over to Matt to get us started.
Great. Thank you so much, Pam. Really appreciate it. I'm going to go over some quick objectives here. Let's see if I can push the audience. There we go. So as Cameron so eloquently introduced us, I'll just give you a brief highlight on our objectives today. Real quickly, my name is Matt Parsons. I'm a Senior Manager. I work on the audit side of the house, or a test side of the house. I'm here at Moss Adams. So I'm going to be talking more about GAAP and financial statement presentation. And Lauren Haverlock is on the tax side of the house, and we'll talk more about the Form 990 and all the complex intricacies that go on with our compliance there. So quickly, our objective today is just to give some perspectives on what is and isn't included in a financial statement and a Form 990, and hopefully highlight the tools when reviewing either or both to give it the most meaning. So one thing to remember is that a 990 is presented in the lens of what the IRS wants to see for compliance, but it can still be used by organizations to tell a story for donors, grantors, etc. where the financial statements, they're presented more under the lens of GAAP reporting. I know in theory that means they're supposed to be clear and provide relevant information to a user such as a donor, a lender, or maybe even an investigative journalist. But there are certainly required elements that, although are intended to be transparent, we all know actually kind of muddles the understanding and often dilutes what the important things are. So while management may want to tell a story through their financial statements, there's often restrictions by standards that limit the story because it includes information that can't be opined on. And so that's why the annual report often includes elements of a financial statements in them, but they're very different documents. So I think all three of these go hand in hand when you're working with organizations that might be recipients of your grants. And just as a side objective, we're hoping that after this presentation, you'll gain a better perspective of what could be missing, from either deliverable, the 990 or the financial statement, and give you ideas for follow-up questions to ask any nonprofits you work with about more useful information. And with that, I will move this right.
Go ahead, Lauren. Before we go over to the polling questions, I just wanted to add in there that, in preparing for this presentation, Matt and I had, a dialogue about the financials in the Form 990. And we know this topic could be a little dry, talking about comparing financials in a 990. It's, not the thing that, people talk about at parties very often. But we kind of had these competing viewpoints of Matt looked at the 990 and was like, yeah, I feel like there's more you can do with it. And I felt the exact same way about the financials. I felt the 990 was pretty rigid. It's a compliance and regulatory document filed with the IRS. Yes, it's public, but you have boxes and you have to kind of fit your presentations within the boxes provided. So I felt the 990 is a little more rigid and that the financials are where I go to see a story. And Matt kind of said the opposite too. So it is funny that we have these internal views and maybe biases towards or against our own documents, but that's just what I thought was really interesting. And in this component, as a tax person, I've always, focused on what the IRS wants to see. They're interested in revenue streams. They're interested in expenses. They're interested in, from the 990's perspective of, what are you doing with your charitable assets? How are you paying people? Is there anyone else benefiting from the use of those charitable assets? Making sure that your shareholders understand where your money is going. And it's been interesting to me to get to better know GAAP reporting and looking at what are the obligations, of an organization and what's the value of the liabilities related to obligations and what are the assets? Like as a tax person, we don't really worry that much about goodwill and other types of invisible assets, but that's something that's really big on the GAAP side because you're painting a picture of what an organization is valued at.
So true. Yeah. And Lauren, I didn't discuss, we're going to have a lot of back and forth dialogue as we go through this presentation. Bear with us. We know this is a better presentation live because there is so much back and forth. So we're sorry we can't be there in person with all of you to do this presentation. But, please ask questions through the chat box. Pam will be monitoring that, and hopefully we'll get any questions answered as we're moving along. All right, with that, let's send it to the next polling question.
Great. Thanks, Matt and Lauren. Yep, and so like we said, we are offering CPE for today's webcast, and here's our first polling question. Approximately how many nonprofit financial statements, tax returns do you encounter in a given year? A, none, I'm just here to learn, just in case. B, 1 to 5, C, 5 to 10, or D, more than I'd like to. So I'll kind of just leave, the polling question open here for a couple of seconds to give you some time to pick the best answer, pick your selection, and then just as a reminder, if you'd like to, if you need CP credit for today, you'll need to respond to at least 3 of our 4 polling questions.
More than I'd like to. I love
it. That's where I land too.
Yeah, me too.
All right, well, wonderful. Well, with that, the next slides are a little bit of an overview of where we're going to go with some of these major GAAP and tax differences. Now, of course, there's a lot of nuance to each of these things, but one of the things we're going to look at is what entities are included and why. The definition of related organizations for each, the financial statements in the Form 990 and how that's reflected. Some of the challenges in a consolidated financial statements and the fact that 990s don't have, tax doesn't have the same considerations from a consolidation perspective. And then we're going to look at revenue streams and what the reporting of kind of a surplus in revenue looks like from an audit and a tax perspective, how they're reported. Next, we're going to see with that revenue in a given year, what makes up that revenue and what are some of the differences. On the financial statement side, there might be some exclusions or inclusions, and same thing with the 990, there can be some adjustments. So helping you reconcile the audited financial statements support with the tax support and what some of those differences are. And then finally, how is the organization using the assets and resources? On the audit side, there's classifications, contract revenue and contract expenses and presentations of those, as well as, what does the IRS care about when reporting these types of classifications and presentations, cost centers and whatnot. And finally, fundraising events. This is, a small element of both audit and tax, but it can present big challenges and big differences for a variety of reasons. So those are each of the areas that we're going to go into. First, before we get into that though, we're going to start with the components of a financial statement, just to kind of compare what a person opening a financial statement is going to see and how that compares to the Form 990.
Yeah, and so we're going to actually have a lot of these slides where we see sort of a combination of both side by side of the different components. And so I think let's just start really quickly on the financial statements. As you can see, we've included a crosswalk as a guide of how the two correlate with each other. There's certainly many nonprofits that still use the term balance sheet, especially those in healthcare. But most nonprofits in a financial statement, GAAP reporting, use a label, a statement of financial position to represent their total assets, liabilities, net assets. And yes, it should balance, of course, but the main objective really is for the statement to show liquidity. The good news is that in this last year, most nonprofits should have adopted a standard which even gives more visibility into liquidity. So definitely want to highlight that when you're looking through your financial statements to look for those footnotes. The statement of activities reports all the income and expenses, and probably more importantly, what was the change in net assets year over year, and did they provide a positive or favorable change or a loss? The statement of cash flows highlights how cash was spent. So as cash balances might be higher at the end of the year because the organization took on more debt that hasn't been used yet, or maybe a significant amount of funding was used to purchase property and equipment, so you saw a big outlay. And that doesn't exist on the 990, which Lauren will highlight here just in a moment. And then finally, the component of the financial statements are the footnotes. And those are where we try to discuss policies, for example, any estimates that management might have used in evaluating the impacts for certain balances. For example, an allowance recorded on a receivable that management assumes won't be collected, what that policy is, and some more breadth and life to what the actual hard numbers are on the face of the financial statements. Lauren, do you want to talk through some of the other components on the 990 and their respective component?
Yeah. One of the things with a lot of our clients that we deal with is a lot of our clients will go through this long financial statement process, and then they'll turn and look to the Form 990 and they'll say, okay, great, you've got the financial information. You are good for the Form 990, right? And we always have to break the unfortunate news to them that no, we need a lot more information for the Form 990. And you can see here that the financial components of the financial statements only are reflected in a very small area of the Form 990. Balance sheet, which is so important to a financial position and the financial statements, is relatively unimportant to the tax filing authorities. The balance sheet we can get from the financial statements. That's one part 10 of the 990 that does carry over nicely. But then when you get to the statement of activities, the statement of activities is presented on the audit. The IRS has a different lens that they're looking at your revenue in. They want to see of your revenue streams Is there any unrelated business income? Are you, doing commercial activities that should be taxed? And so we get the revenue streams, and oftentimes there are things that are, immaterial from an audit perspective that we have to dig into, because $100,000 of unrelated revenue is something that the IRS would definitely be interested in. So we go and break up that revenue into different ways, and that flows through, the statement of activities flows through that way. Statement of functional expenses, we have that as well, but the 990s is generally way more detailed than what's required for a financial statement. Sometimes our clients prepare them consistently, but that's something else that there is some breakouts and separate. We have to break out officer compensation for the functional expenses on the 990, and there's different classifications of certain things that need to get pulled out and reported on separate lines. There's not a lot of flexibility there. And then statement of cash flows, IRS doesn't care about. We don't have any cash flow reporting at all in the 990. And then the rest, if you think about, we've got sections on the 990 that talks about other filings that are required and tax compliance, numbers of W-2s, compensation, benefits, public support, schedules A through O as well as R. That doesn't really have a place on the financial statements. We do look in the financial statement footnote disclosures, and it does provide us some information for, Schedule R, looking at related organizations, or maybe looking at transactions with interested persons. But as you can see, the 990 only has a small element of financial reporting, which is kind of an interesting concept for that. A lot of people call it a tax return, but generally it's more of an information return, reporting, information required to shareholders, if you want to think of it in that sense. The general principle for the 990 is that for the most part, the 990 should be prepared on the same basis that the books and records are kept. So that would be an accrual basis or a GAAP basis if your books and records are audited, it would be that same sort of GAAP reporting. But of course, the same method as your books have to properly reflect the income and expenses. So the IRS really wants to make sure what they're interested in is the income flowing in and, the expenses that go along with that income. So that's one of the most important things when doing that. Sometimes if there's a change to your method of accounting, there could be additional filing reports required. You might have to file a 3115 to show that method of accounting change to the IRS and show them that it's not going to impact anything related to your taxes if you have unrelated business income. But generally, it can follow suit. And with that, we have our next polling question. Pam?
Yes, thanks, Lauren. So for our second polling question, you can complete the sentence. The most meaningful part of the financial statements to me are A, the statement of net position. It tells me how liquid the organization is. B, the statement of activities. It tells me how significant their impact is on a year-over-year basis. C, the statement of cash flows. I like to see how their funds are spent. Or D, the footnotes. It provides more comprehensive information on the financial statement themselves. So I'll just give you a few seconds there. We'll kind of get some responses come through.
Interesting. I'm seeing a lot of responses for the statement of financial position or net position, which Lauren just highlighted is not very important to the IRS for some reason, but clearly I know it is for everyone else that's a user of the financials and financial information. So very interesting.
I like the footnotes personally. That's what I think is really interesting. Good reading.
You have really creative license. Yeah. All right. Are we going to close the poll, Pam? It's already closed.
I think it's closed.
All right, perfect. All right, well, now we're going to jump into some of the differences that we think might have the most relevance to you, as Lauren highlighted earlier. The first area we're going to highlight is consolidation. So I have to say consolidation is probably one of the most tricky and confusing areas of financial reporting. Many nonprofits don't really give it much attention unless they've had consolidating entities for years. But we all know that nonprofits are being a lot more strategic in their alliances, and sometimes relationships that they did not intend to result in a consolidation actually does. And management can have mixed feelings on when this occurs, because I know I recently worked with an organization that had started a separate nonprofit to better qualify for a state government contract, and they definitely did not intend for the two to result in a consolidation for financial reporting purposes. But the way their bylaws were written, upon the dissolution of the new organization, those assets would have to revert back to the original nonprofit. And so that actually resulted in what we call an economic interest. So there's a lot of different elements that go into that term. And in this particular situation, there was also an overlap of the boards that gave them control. And so management was worried that the consolidation of those two entities would actually make the primary organization appear more stably funded than it actually was, and it would result in less public support in the future. So we could tell there was a bias by management in making these decisions, but ultimately at the end of the day, I think providing, again, those footnotes for more clarity and breakout supplementary schedules in the back to give a clearer picture of how each organization's performance are performing gives that detail that they wanted, so that they could still reach out to their donor base and show why they had a need. There might be situations as well where a for-profit organization has a charitable arm that qualifies as a public charity or corporate foundation, and those actually still require consolidation for GAAP purposes. But frequently we see those charitable arms issue their own separate financial statements, and that's okay. So just the rules of rule of thumb, you can always have an individual financial statement for a subsidiary, but a parent organization would not be compliant with GAAP if it presented financials without its subsidiaries, and you can thank Enron for that. So what to look out for: related party disclosures. That's probably one of the areas that have the most importance when you're looking for financial statement footnotes. There might be a case where a transaction was not material enough to disclose. However, usually the materiality bar that's set for related party disclosures is much lower. So sometimes you can even catch when management does not properly report a consolidating organization based on their disclosure. I've seen it happen. Lauren, do you want to talk a little bit about how the 990 does this?
Yeah, so when we have consolidated financial statements, it actually usually presents a little bit of a tricky unwinding for us from the tax side of things. On the tax side of things, there is no permission of consolidation for the Form 990. If you do have, if an organization does have single-member LLCs, those are considered disregarded. And so, yes, in that case, single-member LLC activities would roll up to be reported on a singular Form 990 because the federal government doesn't see single-member LLCs as separate entities. But other than that, if you do have a group of related nonprofit organizations or a couple of related nonprofit organizations for whom consolidation is required on the GAAP basis, from a tax perspective, you have to unwind that financial information and report it on separate tax returns. Even if you do have those the consolidating statements at the end of a financial statement, you do have to then figure out in the footnotes, does this footnote apply? Does, what's reported here as non-cash contributions, is that, for one entity, for both entities, what endowment is this for? So it presents a little bit more work on that side of things. Something else that the consolidation brings to mind on the tax side is related party reporting. So if you do have an organization that's defined as a related organization for which consolidation is required, then you have a lot of additional info that's required to be provided on the 990 itself. There is a Schedule R that asks for related organizations, nonprofit, for-profit, partnerships, trusts, and so if an organization is considered related from a tax perspective, which is a slightly different definition than the GAAP definition of consolidation. A related organization from the tax side of things simply looks at if anyone can control a nonprofit or if the nonprofit can control any other organization. If those control elements exist, which generally is that more than half of the board can be appointed by another party, then that creates that related party reporting, regardless of economic interests and controlling interests. It's just truly can you apply or approve or vote on a controlling member of the boards? Is there ownership of another 50% or more of another organization? That's how it's defined for tax purposes. So you've got that Schedule I reporting, but then you also have another kind of a waterfall of additional reporting with that. And this is because the IRS wants to see these groups and understand in this group what's happening. So you will have to do related party reporting on Part 7 and Schedule J of a 990. That would be reporting compensation paid by related parties for board members or employees of the filing organization. You are required to lump that in. There is a separation of grants that are received from related parties. Grants to related parties are broken out. Schedule R asks to disclose transactions. And in addition, the IRS is interested in certain transactions between related nonprofits and for-profits because some of those transactions could be taxable. So, that consolidation, if we see consolidation on a financial statement, we just know that that opens up a whole other complex world on the Form 990 itself.
What you want to hear about a 990 or tax return? I know we did get a question about cash basis, accrual basis. Just briefly on a GAAP side, technically to be compliant with GAAP, it would be on an accrual basis of financial statement reporting. So primarily that would be required if in California, for example, you exceed that $2 million mark, where the Attorney General requires a financial statement to be produced. You could present as a cash basis. It technically wouldn't be GAAP, but you could still have a financial statement that exists on a cash basis. And then, Laura, I don't know if you want to talk about the tax side, how those two differ.
Yeah, on the tax side, we generally recommend that the same basis that the books are kept should be the same basis that the 990 is prepared. So if your books are kept on a cash basis, then definitely prepare your 990 on a cash basis. There's no requirement that it's done on an accrual basis. But basically any of our clients that have audited financial statements, we present the 990 on an accrual basis to be able to tie it to those financial statements. I have seen some organizations that want to keep their 990 on a cash basis, and so they do bookkeeping entries to kind of unwind the accrual basis for the 990 reporting. But from my perspective, it just seems like that isn't necessary. The accrual basis is what it generally says, whatever the same basis of your books is, the tax return should be. So if your books are on an accrual basis, your tax should be on an accrual basis, which then means contributions are on an accrual basis. Pledges are recorded as income in the year that they're received. And so, all of that flows, and, public support is reported on an accrual basis and all that sort of stuff. So, yeah, it would be on the same basis that your books are, whether it is cash or accrual. Hopefully that helps. And then, Matt, there was a question about statement of activities and impact. I don't know if
I think we're going to have a couple slides later on that I think we're going to highlight that, so we'll save that for a couple slides down the road.
Excellent.
For fiscal sponsor relationships, these are very confusing to many organizations, especially small ones that don't work with them frequently. So there could be some significant misreporting going on from a GAAP perspective. So the basic premise is that if a fiscal sponsor specifically directs who should be the recipient of a gift or a grant, that's what we call variance power, and I'm using air quotes. So that might not exist. And so the nonprofit would not be allowed to record that relationship as revenue. It's essentially acting as like a pass-through entity, and each of those transactions are passed through. So at that point, any cash consideration that's given is recorded as a liability on the statement of financial position, and then as money is actually passed through to recipients, that liability decreases. So some examples could be, for example, a grant is given to a nonprofit who administers grants, like United Way, for example, is a good scenario. And there's been identified third parties are going to be the ultimate recipient, and that would be a case where no revenue is reported and it's just recognized as a liability until spent. However, if, for example, there is like an eligibility component to the funding, say the requirement calls for X amount of dollars to be given to participants that make X dollar of income, but the specific recipients aren't identified, then there's still enough discernment by the organization that would give them what we call variance power. And in those cases, the revenue would be recorded and expenses would be recorded as the money is being passed through to those participants. So just kind of a nuance that's important for financial reporting purposes. And I know on the tax side there's equal nuances, right, Lauren?
That's correct. It's a similar concept. The variance power impacts whether it's income or whether it becomes a balance sheet transaction. So if the organization that receives the contribution truly at the end of the day has the power to divert it to whatever purpose that organization decides to, whether or not it's what the donor recommends, they truly have the power to say yes or no. If that exists, then it would be contribution revenue and a grant expense. This comes into play pretty big on the tax side because it can impact an organization's, a recipient organization's public support. It can impact a donor's charitable contribution. So a lot of times we'll see a donor maybe wants to give money to a foreign organization, and we know that an individual doesn't get a charitable contribution deduction if they give directly to a foreign NGO. And so what they might do is they might find a nonprofit organization and say, hey, I want to give $100,000 to this foreign NGO to support this really charitable thing, helping orphans in another country, but I can't give it directly to this organization. Can I give it to you, because this kind of supports your mission, and can I recommend that you give this to this foreign organization? If it's earmarked to pass directly through and the nonprofit's just passing it through and maybe taking a little cut off the top for administrative fee, that earmarking of that grant, the requirement that it goes to that other organization, would not be variance power. And so that can impact the person may take a charitable contribution if they're giving it to the domestic nonprofit, but if it's an earmark, then that's invisible and it really is directly to the foreign NGO, and it would be disallowed as a deduction to that donor. So that variance power can impact a donor's tax deduction. Additionally, if you think about community foundations, a lot of community foundations that have donor advised funds, they maintain variance power over those donor advised funds. And so at the end of the day, when that community foundation makes an award or a grant from a donor advised fund, it's coming from that community foundation. So the recipient organization, a nonprofit, records it as though they receive it from a 501c3. It's not limited in a public support test, and so that helps an organization, whereas if a nonprofit gets a large donation from an individual, it could throw off their public support and put them into private foundation territory. Now the IRS is kind of keen on these nuances, and so they've looked at putting additional restrictions on donor advised funds, but that hasn't happened yet. So it's just really important that if that grants do pass through, that there is a variance power with that recipient organization to make sure that deduction can truly be taken by the donor, and that nonprofit isn't participating in some sort of tax scheme in a sense, because the IRS does look at step transaction rules, and that concept is that they'll look at the start of a transaction and the end of the transaction, and if they see that all the steps made in between, while they might technically create various tax patterns, if it's meant in a broader way to avoid taxes in a sense, they're going to eliminate the middle transactions and just kind of take that from A to C rather than looking at that B step. So hopefully that makes a little sense, but the fiscal sponsor rules do impact on the tax side. You don't really see it on the 990. Yes, maybe if you don't have variance power, it shouldn't be a charitable contribution on Schedule B, and it shouldn't be a grant on Schedule I, but it's really important more from a tax deduction standpoint.
Great. Right, moving on. So I think this is answering the question we also got on the impact on the statement of activities. So, the question that we've posed here is, did the organization have a surplus or a deficit during the year, and how did it compare to last year? So we have here on this next slide a summary of 2 years side by side to really compare what you're looking at. So when reviewing the statement of activities, there's a few things to be focused on. The change in without donor restrictions, and then the total change in net assets. In this example, in the prior year, the organization had $100,000 of expenses greater than revenue without donor restrictions. Remember, that doesn't necessarily mean that they spent more cash than they took in. It just means that they could have had deferred costs that were amortized, like depreciation expense on property equipment. But when you look in total, because they received a pretty significant contribution or grant that was restricted, their overall change in net assets looks pretty good. the key to look at is the footnotes, I think, and how much of that $1.4 million in the prior year is restricted grants and contributions that's going to be held in perpetuity, would be like an endowment that you wouldn't be able to use that spending for multiple years. In the current year, we can see that the organization's restricted gifts are significantly less, but they're continuing to use that same proportion of past gifts for their purpose, which is resulting in a positive change in net assets without donor restrictions. But because the gifts were overall down, the total impact on net assets actually resulted in a loss for the entity. So I think the key takeaways to look at is how dependent the organization is on grants. For example, do they have other revenue streams to support their operations? If they are highly dependent on grants, how quickly are they using those funds for their purpose? Those are, I think, the most key elements to look out for. Do you want to talk about the tax changes, the change in tax purposes, Lauren?
The funny thing about this is that revenue less expenses, isn't something, it's on page 1, it shows up on page 1, and this is revenue less expenses from a tax perspective. So it doesn't include some of like the, unrealized gains and things that we'll discuss that impact tax later. But it shows up on page 1 of the 990, and it can kind of doesn't break up that difference between donor restricted and with and without donor restrictions. That isn't really much more of than just an informational reporting. So we combine those two amounts here on this reporting for page 1 of the 990, and then you'll see as we look at kind of the revenue and the items here, donor restriction doesn't play out in how we report revenue. It's truly what the IRS wants to see. They want to see, is revenue related to your exempt function? Is it unrelated? Or is it not related to your exempt function but not taxable because it meets an IRS exclusion from taxable income? So the revenue streams to them, they want to know, how are you earning money? Are you doing it in a way that serves your purpose? Obviously, charitable contributions don't get allocated to either of these columns because they're simply a one-way transaction. Charitable contributions don't have to worry about that received in. But program service revenue and other types of revenue do have these considerations from an IRS perspective. But as you can see, donor restrictions is not that significant in that sense.
The next topic is, what was the total support? Go ahead.
Go ahead, Matt. Sorry.
I was going to say, the next topic was is looking at the differences in support revenue during the year that might have no impact to the bottom line. So we have a couple different scenarios here. The first is in-kind donations. So many might think it's silly to probably report in-kind contributions on the financial statements, especially if they net out and have no impact to the bottom line. But it actually can be pretty useful information. And we're seeing more nonprofits, especially with COVID happening, that merge with one another. And if a nonprofit previously had, for example, a free rent situation because of a relationship they had, and that potentially goes away as a result of a merger, it's important for the acquiring organization to know what could be an additional cost to them should that in-kind gift go away. Similarly to like a legal aid society that might depend on pro bono work from local attorneys, it gives you a sense of what it would cost them to engage those professionals, if those relationships didn't exist. Some organizations we know do tend to overvalue these costs and revenues to make their total numbers look a little bit like they're a larger organization than they actually are. And many nonprofits, I would say, probably don't have access to good resources to properly value these in-kind contributions. But there are new requirements that have been issued for much more enhanced disclosure for this in the future. And primarily this was because of pharmaceuticals that have been passed through to many organizations where there might not have been a market to sell these other than what you would see at your local pharmacy. And so we were seeing pretty inflated values of these in and outs that, for GAAP purposes, we're hoping to provide more context and information on. Lauren, did you want to talk about the tax impact?
Yeah, and on the tax side, here's another area that the IRS doesn't, they do care. They care about it from a perspective of of donors. So doesn't matter to them the value of an organization. They want to know, they don't want to know any information about in-kind services or in-kind donated facilities. So donated services and donated facilities have no home on the 990 and should not be included on the 990. It's just a reconciling item that we pull. It doesn't have any tax impact to the bottom line because for the most part you pull it out of revenue and you pull it out of expenses. In certain cases, sometimes it gets capitalized, and so it could, and donated services might get capitalized if you have like an architect helping with building a building, that could get capitalized, and so that maybe impacts bottom line. But generally it doesn't, and this follows the IRS's rules on charitable contributions. If I donate time to a nonprofit, even if it's professional time, so if I prepare, a tax return for a nonprofit organization, I can't take a tax deduction personally of that time because my time has no basis if I'm not getting paid for it. Same thing with the use of a space, the use of facilities. You can't take a deduction for which you have no tax basis, a charitable contribution deduction for which you have no tax basis. And so, that is something that you can't deduct from an individual. So nonprofits shouldn't be acknowledging donated services, and nonprofits shouldn't be acknowledging donated facilities. You do report on a 990 any in-kind contributions that are tangible goods, so certain things that you receive for gala events, that all should get included. And that, in fact, sometimes if you do have galas that have significant silent auctions, sometimes you don't see those non-cash contributions even show up on the financial statements. They might not be material. They do kind of net out, right? If you get non-cash contributions in that are then sold for auction, maybe the audit just reports the proceeds. On the tax side, you have to report the donated goods, you have to report the sale of those donated goods, and then you have to report the cost of goods sold. So there's sometimes some differences in those senses, especially if it's immaterial, but tax does want to see donated non-cash goods that are, tangible property. And that's very important to the IRS because they are looking in that sense, not at the nonprofit, but at the donor. Are donors taking inflated charitable contributions of non-cash items? So that's just something to note. And what we showed here is that the GAAP entry debit, rent expense, credit, donation revenue would be reversed from a tax perspective to pull those amounts out. And they do get pulled out for the 990, and they get reconciled, as you can see here. On Schedule D, there's a reconciliation of revenue per audited financial statements with the revenue per the tax return, and same thing, a separate reconciliation of expenses per the audit and expenses for the tax return. And you can see that donated service and facilities is pulled out, from and I'm saying there's a math error here, but you'd pull out the $100,000. Oh no, it's actually fine. Pull out the $100,000 from that total revenue, and that would get you to where you are. But at the end of the day, it wouldn't impact the bottom line. But there is some, we talked about other in-kind items. Donated securities are also kind of a unique situation. So Matt can discuss how donated securities are accounted for on a GAAP basis, and then we'll talk about the tax side of things.
Yeah, so donated securities still act as contributions. They're the same, but for cash flow reporting purposes, frequently there's an elective policy that can be made that says that if a nonprofit essentially liquidates by policy any donated stock or securities immediately, then it's essentially treated as though it's a cash contribution. And so you only see it on the statement of cash flows as cash. You wouldn't know that the original form was a security. But as Lauren will explain, that has a very different impact. And so keeping track of those securities for tax purposes is pretty important, right?
Yeah, it is. I mean, for a nonprofit organization that's a public charity that files a 990, you do need to report the sale of the security, so it would show up as a non-cash contribution, and then the sale would show up as a sale of securities, which generally would have very, very low capital gain from, if you have a public charity Form 990. This does, technically that's a little bit off though, because when a person donates securities to a nonprofit organization, yes, they get a deduction of the fair market value of those publicly traded securities the date of the donation. However, the basis of those securities technically carry over. So if for some reason there's a tax to be paid on the capital gain from the sale of securities, say you're a private foundation, which I know we have a lot of private foundations. This 990 is not for private foundations, but lumping in that fact, if you're a private foundation and you receive donated securities, you have to get that carryover donor basis for those securities when you report that capital gain for tax purposes to pay tax on. You don't, while it might net out to zero if you immediately receive them and sell it, you might seem from a GAAP perspective that it nets out to zero capital gain. From a tax perspective, you might have to look at that donor's basis, but that's really only for private foundations. And any, for some reason that was unrelated business income, which capital gains usually aren't. So just a quick note that, of course, again, this is something that becomes a public charities issue, but it really is the IRS looking at that original donor and their issues.
All right, now we're going to talk about just a couple items where there might be differences between financial reporting and tax reporting for the purposes of impacting the bottom line. So, unrealized gain and loss on investments. Just real quickly, so GAAP requires presentation of investments at fair market value. And so, of course, there is adjustments for unrealized gains and losses that do impact total support and revenue. The one caveat I'll say is that it may be broken up into two places on the financial statements because some organizations with significant endowments tend to report investment income from those endowments as partially non-operating activities, and then any spending policy appropriations determined by the board then gets reported as operating. So there might be, again, just two places where you see that. And last year, GAAP did require that expenses that are incurred, for example, broker fees, investment manager fees, that those be shown net of investment income. This was a pretty common practice, but not technically permitted before last year. So from a financial statement reviewing process, you may not know how much was spent to acquire those earnings.
And on a tax basis, the IRS doesn't care about unrealized gains or change in market value. It's not a revenue item, so we pull it out, and you can see that adjustment on Part 11, the reconciliation of net assets. Anytime that basically we see publicly traded securities on the balance sheet, we expect to see some sort of unrealized gain or loss in a given year. So that's another thing that the IRS doesn't care about. Uncollectible pledges and refunds have different treatments too, so Matt will jump into that.
Yeah. So while GAAP does require losses from prior pledges to be recorded as an expense, that might not always be a consistent practice. Many organizations, I think, see it as an embarrassment, and they try to bury those losses somewhere if it's not material. But many organizations don't have great policies to record allowances for gifts at the very beginning, either because they don't have enough history with pledges or and know the likelihood of collecting, or they don't know their donor very well to know that it might result in a loss. And so one key thing to look for in the footnotes is if any collections are expected beyond 5 years. Pledges that are greater than 5 years are much more likely to not be collected. Many organizations now are modifying their gift acceptance policies to limit how long a pledge can be before they accept it. But just know that for technically financial reporting purposes, any uncollected amounts do get reported as an expense. And
on the 990, they don't want to see these as expenses, uncollectible pledges or refunds of prior year grants. They don't want that to either increase or impact an organization's statement of functional expense and their allocations there, or overstate their revenue. So it should be reported as a change to net assets, where we highlighted that the unrealized gains show up. It would just go there kind of like that, or a prior period adjustment, so that it doesn't skew any revenue or expenses in any given sense. So one of the other areas that we differ, and with that, knowing that we only have, 10 more minutes, we'll spin through the next poll and get through the next section.
Yep, we'll quickly do this poll question. It's pretty short. Do you currently perform reconciliations between the financial statements and the Form 990? A, yes, B, no. So we'll just kind of leave this open. I'll just give you a few seconds. It should be a quick one so that we can proceed on to the next sections. Okay, I'll just wait a few more seconds here. I'm looking at the number of responses coming through. Almost there. All right, I think I'll go ahead and close it. And here are the poll results.
Good mix.
So it's about split. Yeah.
Good. Did you need a
The use of resources. Oh, no, we're good. How an organization uses its resources, there's a lot of differences between GAAP and tax. And from a tax side, I'll kind of overstate it by saying that, on a tax perspective, the theme is going to be, is something being used for proper charitable purposes? But that, that's something that's going to be a little bit different from the GAAP side of things. And so I'll let Matt take it away with that.
Yeah, just real briefly, there has been a lot of changes recently for nonprofits for how grants are recognized. That's because under contract accounting for for-profit organizations, there's a lot of new requirements to evaluate, if a contract exists, when is the revenue actually earned. And just know that currently grants are actually almost treated more like contributions. So essentially they're recognized at the time they're awarded unless there's some right of return. So for example, they didn't spend the money according to the original purpose of the grant, they'd have to return it to the funder, or there's some measurable barrier. For example, you're not eligible to really receive this money or recognize that money until you've, matched it with another $500,000 of other contributions that you've raised outside of it. So there are some new differences, but otherwise they're pretty much straightforward, I would say.
And on the tax side, these changes for GAAP came into kind of conformity with how we've always had to do it on the 990. We've always taken a look at grant contracts and said, is there a direct return benefit to the grantor, the government agency? Are we helping the general public or are we helping that agency directly? And that's defined whether, a grant is a contribution or program service revenue. And so really the way of looking at it is the same from an audit perspective. If there is a one-way revenue, there's no return benefit contribution. There is a direct return benefit program service revenue. And that definition, kind of carries the day on that. Same thing, I'll talk about the 990 expenses if Matt wants to then talk about GAAP, but from a 990 perspective, expenses to secure contributions or one-way revenues are considered fundraising expenses. An expense to secure two-way revenue would be program service expenses. So, something to note, a lot of our clients that have government grants say, well, we don't have fundraising because we're not out there doing fundraising. Well, if you're putting in efforts to support and maintain government grants, anyone who has contribution revenue, government or otherwise, should have some sort of fundraising expenses because there's always going to be an expense to obtain those funds, whether it's from the government or otherwise.
Exactly. I think we're going to touch on that a little bit on the functional allocation in the next coming slide, so I'll just wait and dive into a little bit more when we get to it.
Great. Jump along.
All right, so how does the organization use its resources? So only until last year, many nonprofits weren't actually required to disclose their expenses by natural category. For example, the amount spent on salaries versus rent or professional services, but now not all of them do. And the methodology for how certain costs are allocated between programs and, say, management and general expenses versus fundraising, it has to be more clear. So a lot of entities probably don't get it right, and as Lauren will mention, I know the 990 has always required a breakdown of this functional classification. And what we learned last year when a lot of these organizations were adopting this new method is that they were really thinking about their allocations more clearly, knowing that would maybe reach a broader audience through the financial statements. And so there was some pretty significant revamping going on with how their estimates are occurring and taking place. And I suspect even in this current year, we'll have that similar reviewing those estimates. But typically one area I ask my clients is, how honest they're being with themselves on the expenses they're reporting as fundraising. If they rely almost 100% of their revenues on contributions and grants, but have virtually no fundraising expense, that to me is a red flag that there's something in their allocation that's probably wrong. Because how are they getting those contributions if they're not doing certain activities to solicit those contributions and grants? What are you seeing on the 990, Lauren?
Yeah, I don't know if you want to go into the example that they have that you have.
This is a bad example, so I'm going to skip through it.
That's right. From the 990, we see the same thing. We see people fearing reporting administrative and fundraising expenses. However, there's been more and more discussion in the past years about the fundraising and the overhead, the management general overhead myths, that those are inherently bad, that a nonprofit should have as much programmatic expenses as possible. I think a lot of organizations think that nonprofits should be leveraging their resources to raise more money, and they should be leveraging their resources to ensure that they have proper structures in place. So, we take a look at it as well and look at reasonableness, and we know that that there's a lot of pressure on nonprofits because of the charity watchdogs out there. Something that is we don't talk about much is there's this whole simplified method of allocation, which actually not many of my clients do use. But if you do have an organization and you have cost centers and you don't have an easy way of allocating costs amongst a very easy way to allocate the costs amongst the various categories, there is a way that you can use the simplified method of reporting, and that's something it would just be a matter of allocating your cost centers along a line of kind of this. I think this example shows it the best. You might want to pull some of the expenses in one column over to program service expenses or vice versa, and just show the allocation as a negative amount in one column and a positive amount in another column. And that helps to highlight those cost centers and reflect on the 990 a more simplified method of doing that. So I know we only have a couple minutes left. Should we hop over to the next polling question, and then we can go back to the netting of income and expenses?
That sounds good. And so this is our last polling question. What section of the Form 990 is more interesting in your review? Part 1 summarizes the organization and compares the current year to prior year activity. Part 3, I gain a better understanding of the organization's programs and what it spends to carry out those programs. Part 7, I get a sense of how they compensate their board and top management. Or is it Schedule L? I can learn if the organization engages in excess benefits. Oops, I think we were hopping along. Or is it Schedule R? So I think we've got most responses coming through. And I think we've got most of it. And it's looking like here, Lauren and Matt, it's looking like I think it's part 1.
Oh, great. I'm surprised. I would imagine Schedule L would be more interested, but I don't know if we didn't get some of those polling answers before we moved along that slide. So do we want to jump back to the netting of income and expenses, Matt? I know that there's a difference.
Yeah, and I already talked about this. I talked a little bit about that already, so if you want to talk about the tax impact.
Yeah, just overall on the tax side, the IRS does not allow netting. So they want to see everything, and I'll highlight all of the examples that we have. They want to see everything reported unnet. So, a lot of times we'll have to go through and break out expenses that are lumped into income, such as those management fees for investments. A lot of times with colleges and universities, tuition is shown net financial aid. On a 990, we have to unwind those amounts and we report financial aid as scholarships and grants, and we report tuition gross. And UBI, we focus a lot more on UBI. If audit reports unrelated business activities, we then have to go into a lot more detail. We show it we unnet that amount, we report the gross amounts depending on the category of that UBI on the statement of revenue, and then the expenses are kind of lumped into the functional expenses. They should be allocated to the management in general column, but that's just not going to tie exactly. We usually have to separately obtain information from clients regarding their UBI streams, and we always recommend that they separately track them so that we have both direct and indirect expenses that support UBI allocations. So let's move along to fundraising events. Fundraising events are something that is really, in our last 1 minute that we have, fundraising events is something events that aren't technically related to an organization's exempt purpose, but they occur to, promote an organization and raise funds. The IRS's concern in fundraising events is they don't love them. They don't love the fact that nonprofits spend a lot of time and effort sometimes fundraising, so they create a reporting for the fundraising that pulls out, the contribution element of those fundraising events and show, kind of the costs, the direct costs and revenues earned for the direct benefits provided in those fundraising events. One thing to note, gaming is not a fundraising event for tax purposes. The IRS purposes, they have to be separately reported. That would be raffles and other activities. And we have some examples in our slides about some of the differences between GAAP and tax. But what I want to highlight is that for, fundraising events, this is kind of the simple overarching, presentation from a GAAP perspective. Matt, I don't know if you want to say anything about this presentation of a fundraising expense for financial statements.
Other than there's a lot of different options available to you, I just want to say, though, this is only available if their events are incidental to the overall activities of the nonprofit. So if a nonprofit actually relies on events, like they host a large annual trade show as their primary source of revenue, then they wouldn't be able to report it under one of these three methods. They would actually report, gross ticket sales as revenue, and then all the costs would be broken out into their natural category, like rent for the venue and professional services for those used to engage to put on the show. But there's a lot of different options as long as you're calculating that valuation correctly of what is a ticket sale versus other aspects of the event. What's a true contribution, which I know is important for tax purposes as well.
Yeah, and for tax purposes, we have to kind of slice and dice the revenue and expenses of a fundraising event, especially the revenue. And, something as simple as this, we have to identify, is this event accounting for donated non-cash contributions that are sold? We briefly touched on that when we talked about in-kind items. Does that ticket sale have a bifurcated, a portion that's quid pro quo, amount tit for tat, like something that's received in exchange, a dinner, like if you buy a gala ticket for $100 and it says $20 is your return benefit, we have to separate that $80 and $20 as different revenue streams. We have to do the same thing for sponsorships. So, and then we also have to break out gaming. So raffle and auction oftentimes are lumped into one, but the raffle is considered gaming here in California and also from the IRS, so we need to separately account for those items too. So some very simple fundraising events can lead to some kind of complex adjustments from the tax perspective. Doesn't really impact the bottom line, but it could, impact and better highlight how that event went. So here you'll see this example. We have broken out and accounted for proceeds from auction in excess of fair market value. That's just, the donated part of the auction and the costs of those donated items that were sold in the auction. And then this further shows that now, on top of, that, maybe it's just overcomplicating things and shows you how, this is something that may not seem material from a financial statement perspective, but from the IRS perspective, they are very interested in this. You then have to look at what's a contribution and not a contribution. And then finally, all of that comes into account on the Form 990 Schedule G, putting that information to highlight your fundraiser. And because of the way that things are broken out, your fundraiser may look like it lost $8,000. You had an unsuccessful fundraising event, or actually $63,000 of that event was reclassified as a charitable contribution. And so, it's this perception, what the IRS wants to see, hey, you have to reclassify some of this revenue to the, perception of the IRS and the perception of the general public of like, why are you putting on an event if you're losing $8,000? So just some other areas of complexity. And I know that we've gone over by 4 minutes, so I appreciate everyone sticking on. And we don't have a lot of time for questions, but if you do have any questions, feel free to reach out to Matt or I on any of this. And we have tons of resources, on the Moss Adams website, so you can always go there as well. Pam, or Cameron, do you want to close this out?
Yeah, no, thank you so much, Lauren and Matt, for a great presentation. We were recording the session, and we'll send a link as well, just in case you wanted to kind of listen in again. But here are links to previously presented webcasts that we've done for this education series. So feel free to listen in. When you have time, these links are available. I also wanted to mention that you will be receiving an email shortly from Southern California Grantmakers with a link to an online survey where you can provide feedback for today's presentation. And again, if you needed CPE for today and you completed all CPE requirements, you should be able to download a copy of your CPE certificate in the slide, and it's within the platform. Otherwise, we will be also sending an email, probably in 3 weeks, with a copy of your CPE certificate. Again, thank you for joining us, and we hope you'll join us again next time.